Malandrino, global markets reporter at Nasdaq. Joining us live in the market site, Times Square, New York City, we have Joyce, managing director on Nasdaq's market intelligence desk, for an update on Nasdaq-100 activity. Brian, it's our first time we've been together in 18 months.
It's been a while.
It's good to see you. A lot has happened
nice to be back.
in between now and then. And let's get right into it and take a look at a couple of charts here with fresh levels on the Nasdaq-100. It's nice to do this in person, not over your Bloomberg anymore.
Right, exactly. So yeah, I mean, so we've had some recent turbulence in the markets lately. You know, rates have been coming down for quite some time. Equities over the last week, Monday especially, we had a big plus 2% decline. Overall, in the grand scheme of things, you can see the trend is clearly to the upside. In the top right-hand corner, I did just highlight the price gap that was created on Monday. The NDX and what we're looking at here is the ETF for the NDX, the triple Qs, hasn't yet filled that price gap. And so it's not the most bearish thing in the world, but it is a near-term resistance level that I do want to see the index get back above before I'm feeling a bit more comfortable about what's going on in the marketplace. This time of year, this is seasonally a very weak time of year. September is the worst performing month going back to 1950. October tends to be a pretty volatile month as well. And then given what we've seen in the rates complex, particularly in spreads, they've come down quite a bit. I just don't know if we're out of the woods yet. The intermediate to longer term trend is certainly higher, and so I feel good about that. But in the near term, I wouldn't be surprised if we do see some volatility, despite the positive price action today and yesterday. And
you're also taking a look at Bollinger Bands from a technical perspective. How do you use that indicator, and what's it showing you right now?
Yeah, absolutely. So they're a measure of volatility, and it's very common, during uptrends to see stocks, indices, whatever we're looking at, pull back and test the midpoint of the bands, which is just simply the 20-day moving average. Yesterday, I should say on Monday, when we had that big gap down lower, we broke strongly down below the 20-day and even down below the lower band. That's a 2 standard deviation move. Typically, when you get down below there, there's a period of consolidation. The question is, will that be sideways? And then from there, maybe we resume the downtrend, or will be a back up V-shaped rally. So far, we're seeing that move higher, which is nice to see. So I want to see us, one, fill that price gap, get back above it, and then number two, get back above that 20-day moving average. And that would, to me, make me feel a lot more comfortable that the near-term volatility, is in the past.
It's so interesting, Brian. At the beginning of the year, it felt like everyone was so hyper-focused on the 10-year. Right now, we're talking about Evergrande. Now we're talking about the debt ceiling, and we kind of haven't noticed just exactly what the 10-year is doing and how it's impacting individual sectors like the financials, as an example.
Right, absolutely. The rates and financials, they're highly correlated, about 0.5. So, and we know that the long rates peaked back in March or so, and that's when a lot of the regional banks peaked. Some of the money center banks have been recently making new highs, but they have much broader business lines, such as capital market lines, trading, investment banking. But what we're seeing now is, even though the 10-year yield bottomed in July and August and since been about 10 to 15 bips higher from there, we're seeing here on the longer end of the curve, this is a chart of the 30-year and the 5-year spread, and we can see that it's at a 14-month low. We haven't seen these levels since July of 2020. So that's an indication that the marketplace is concerned potentially about growth coming down, and we have seen those expectations, being lowered by the Atlanta Fed, so and analysts across the street. So it looks like the rates market picked up on that before, say, maybe other areas of the marketplace. What we're highlighting here on this chart, with the two arrows, is the one from back in June was the June FOMC, and we can see we had a hawkish Fed there, and the rates really collapsed strongly. And then again, yesterday's FOMC, even though the trend going into it was to a flattening move, we did see continued downside. We did bottom right around those lows from July of last year, so maybe potentially the low is in for this rate compression, the collapse in the spread. And if that's the case, then now you would want to be building up and taking risk on, particularly in those more value-oriented cyclical groups like financials, like energy, things like that.
Yeah, which is so interesting too, because a number of analysts have actually taken up their sector ratings to outperform and have raised them a bit. So, it's always good when you see the fundamentals and the technicals align. Right. Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.